Good afternoon, everyone. My name is Ellie Garrity, and I'm the manager of Alumni Career Programs with the University of Maryland Alumni Association. We're excited that you're able to join us for today's webinar, The Road to Retirement, presented by alumnus Patrick Moriarty. This webinar is part of the Alumni Association's Professional Development webinar series, in which we hope to provide thought-provoking and valuable content that will help alumni like you achieve your personal and professional goals. If you know any fellow Terps that may have a great topic to present on, or you yourself would like to present on one of our webinars, please let me know. Please keep a close eye on our upcoming webinar series as we look to provide relevant content during the COVID-19 outbreak to help you continue to be successful at work and at home. Okay, we have a lot of information to cover today, but we want you to get the most out of this webinar. So feel free to submit your questions throughout the presentation in the chat box, and we will make sure to get them at the end of Patrick's presentation. Now about the presenter. Drawing on an economics degree from the University of Maryland and his 25 years of experience in the financial service industry, Patrick has gained a unique perspective on tending to his clients' individual needs and concerns. His goal is to assist his clients to obtain financial well-being while helping them manage risk against life's unforeseen events. Patrick has worked and consulted with major organizations such as Wells Fargo, Smith Barney, and Merrill Lynch, and has helped hundreds of his clients implement plans in the areas of insurance, investments, retirement income, and estate planning. Married for 23 years to his wife, Marion, the Moriartys enjoy traveling and spending time with their two active and accomplished children. He considers his service to others to be one of his greatest passions. And now we will get started. As Patrick begins, we will launch our first poll so we can find out who is joining us today. And with that, go ahead, Patrick.
Oh, thank you, Ellie. Thank you for that nice introduction. And I also want to thank you for inviting me to host this webinar today and to get a chance to speak to some of the alumni of the University of Maryland. You know, Ellie and I put this on the books, on the calendar several months ago, and I couldn't help but think that the timing of this is absolutely perfect for a couple of different reasons. One, you know, everybody is cooped up at home. We've all got cabin fever. We're all looking for distractions for our new normal. So it's a perfect day to host this webinar. And also with what's going on in the financial markets over the last, 4 or 5 weeks, with all the volatility and all the craziness going on, we'll be able to address some of that today in the workshop with what's going on with market volatility and how it affects, the younger people. We've got, people under 30, how this volatility can affect them. And then we've got people over 50, how it affects them as well. And it affects everybody differently. So I hope to address that as we get in further into the webinar. So I'd like to start with the agenda. And that will be, I will start with Social Security planning, and I'll do a high overview of Social Security, how your benefits are calculated, how they're taxed, rules around Social Security. We'll talk about some filing strategies, and then finally we'll talk about some different case studies that we see from all these workshops that we do every month around the state of Maryland. I'll then transition into the different types of retirement accounts that a lot of people are using today as they plan and prepare for retirement, the rules around those plans and how they're taxed. And we'll talk a lot about taxes in retirement and how to reduce taxes on these retirement plans. And then finally, we'll transition into just the overall planning process, what that looks like, and the different types of risks that people face as they transition from their accumulation phase to the distribution phase, and what those major risks are and how to try to avoid them as you near retirement. And then one last thing, before I start, if you hear me cough or sneeze, it's not the coronavirus. My allergies are just going crazy on me with everything in bloom. So I'll try to hit the mute if any of those two come up, if I cough or sneeze on you. So let's jump right in.
And Patrick, I'm just going to say, if you weren't able to see, we got our poll results in. So it looks like 44% of folks are in the 50 to 69 category. And then we have a good percentage of folks that fall into other categories. And then we did get a message from Victoria that said she's part of the 20 to 29 age bracket. So it looks like we have a diverse crowd here.
Good. Excellent. Excellent. And so, as I mentioned, I do these workshops every month throughout the state of Maryland. And our mission, whether it's a workshop or a webinar, is motivation through education. We really want to help people learn more about retirement so that they can live a happy, healthy, successful retirement going forward. So that's our mission. It's educational, informational, no selling whatsoever. Full disclosure, I do not work for the Social Security Administration, the IRS. I am not an accountant, a CPA, an attorney. As Ellie mentioned, I am an independent financial advisor with over 25 years of experience in the business. So just have to get those disclosures out of the way. So let's jump right in with Social Security. Here are some very interesting facts about the Social Security Administration. 67 million people a month receive a benefit from the Social Security Administration. 5.5 million are new each year, and over 55% are women, and that's just due to longevity and life expectancy. Women live longer. One stat that is not on there is that 10,000 people a day are turning 65, and that's not just today or this year. This is for the next 8 or 9 years. So we have a tsunami, we have a wave of retirees that are hitting Social Security, Medicare, our healthcare system, and really will change our economy over the next several decades. So it'll be interesting to see how this plays out. It'll be a very interesting time for us, I think, economically as well. So why is Social Security so important? Well, it's the foundation to everyone's retirement. There's a pie chart on the left shows what I call a perfect retirement. It's a safe three-legged stool in retirement. We have someone who might receive about 1/3 of their income in retirement from Social Security, maybe a little over 1/3 of their income from personal savings, and if they're fortunate enough, maybe less than 1/3 from a pension. If they work for a government agency, or if they're fortunate enough to work for a corporation that still offers pension, that's a perfect retirement. A nice three-legged stool but for a lot of us, it's a two-legged stool. It's our personal savings and it's Social Security, and it's very difficult to sit on a two-legged stool. The bottom line is that for most retirees, Social Security will be the first or second largest source of income in retirement. So it's important that we get it right, and we get it right the first time. So the first step in the planning process, the whole planning process, is to know what your Social Security benefits are going to be. So whether you're new to the workforce or you're close to retirement, and you want to know what this data is year after year after year, one easy way to do it is just to set up an account with the Social Security Administration. It's ssa.gov. This is what the landing page look like when we put this presentation together. But you can just create an account, and every year you'll see what your benefits are and how they change each year. The most important thing to do once you do that, when you look at your statement, whether it's online or if it's in the mail, is to just double check the data. It's not always correct. The federal government isn't perfect. They do get some things incorrect. For the older workers, you might not remember what you earned in 1991 to the penny, but make sure that every year that you work, that there is an income inputted for those years that you work. They do make mistakes. Check your birth date. I've had a client where, the birth date was wrong, and it was very, very difficult for them to get that changed. So double check your data, double check your information, and make sure it's correct. So when it comes to filing for your benefits, the earliest that we can file for our Social Security benefits is 62 years old. The latest, the maximum age that we can delay it is 70 years old. And then in between the two is something that that Social Security calls the full retirement age. And for our discussion today, that will be the age of 66 years old. So they're 62, 66, and 70. But if you're born after 1955, your full retirement age is going to creep out closer to 67 years old. And if you're born after 1960, as am I, my full retirement age is 67 years old. But for our discussion today, we'll always refer to it, just to keep it simple, as 66 years old. So how are the benefits calculated? Well, very, very carefully. The Social Security Administration looks at your top 35 years of earnings. The minimum amount of years you need to work is 10 years, 40 quarters, 40 credits, they used to call it. It does not have to be consecutive. To be eligible to be put in the ball game, you need to work 10 years. But Social Security will look at your top 35 years. They will adjust those earnings for inflation, and they come up with a monthly average over those 35 years. It's a monthly number, and it's referred to as the average index monthly earnings. So we take that monthly number, we apply 3 bend points to it, add the bend points up, and we come up with your primary insurance amount that you then receive at full retirement age. So let's review. We have the AIME to determine your PIA that you receive at FRA. Is anybody confused yet? Well, if we go to the next slide, we'll see, make it a little bit clearer. So let's just make an assumption that the individual's average monthly index over 35 years, let's say it's $6,000. So we start with $6,000. We apply these 3 bend points. We get 90% of the first $960. We then receive 32% between $960 and $5,785. And then we receive 15% over $575, up to a limit, up to a cap. And you add those 3 bend points together, and that is your primary insurance amount that you receive at 66 years old. So the bulk of your benefit really comes from this middle bend point between 960 and 5,785. And there is a cap. I'll show you what that primary insurance amount maximum is this year for each and every individual. But excuse me, the bottom line with Social Security is that the longer we wait, the bigger our benefits will be. So when we look at our benefits on our statement, we'll see a number for 66 years old. That's at full retirement age. In this case, it's $2,000 a month. If an individual takes it early, they're penalized. There's a reduction. They take it at 62 years old, there's a 25% reduction in that benefit going forward every year. At 63, it's less, but at 66 years old, that's your full retirement amount, that's your PIA. And then if you delay it past 66, you get a bonus. You get a delayed retirement credit of about 8%. And it can go all the way to 32% at the age of 70. So as you can see, there's a big difference between taking it at 62 and taking it at 70. It's 80 to 90% more. It's a big difference. So not everybody can wait to 70 years old. The percentage of people that wait to the age of 70 is less than 10%. It's between 4 and 8% between men and women. So the bulk of people do take it at 62. It's in the 40s, 40%. So not everybody can wait to 70. A lot of reasons for it. It could be health reasons. They could get laid off. There's so many different reasons why people take it early, but if you can, the longer you wait, the bigger your benefit will be. So how much should you receive? Here are some averages depending on what your income would be. So if someone averaged, let's say $50,000 a year over their history of work, at full retirement age, they would receive about $1,800 at full retirement age. So someone here on the workshop or the webinar might be thinking, well, I've averaged double that. I've averaged $100,000 a year. So my benefit should be closer to, let's say $3,700. Well, when we go over to 100,000 and we look at full retirement age, it's only about 2,700. And that's because we're starting to get towards that ceiling, that maximum, if you will, of what somebody could earn at full retirement age. And again, I'll show you what that number here is in a minute. And again, if you wait past 66, that number grows by 8% a year. Now, along with receiving your benefit every year, almost every year, we get what is called a cost of living and adjustment. Over the last 20 years, it's averaged about 2% a year, but it's not always equal to 2%. You know, there were years, if you look here at 2015 and 16, basically back-to-back years of almost 0% increase. 2009 and 10, we had a couple of zeros back-to-back. But on average, it does increase at about 2%. And also, if you haven't started receiving your benefit, there's a cost of living adjustment even to what your benefits will be in the future. So the cost of living not only affects people who are receiving it, but it's for people who are still years away from receiving their benefit. So two of the biggest questions we get from these workshops are, can I work and collect Social Security, and are my benefits taxable? And the answer to both of these questions is always the same. Well, it depends. It depends on a couple of different things. So let's start with, first of all, can I work and collect my benefits? And we're going to look at 3 time periods. We're going to look at the first box in the red, which is years under full retirement age. So we'll look at age, 62, 63, 64, 65. And then the green box is the year in which you turn full retirement age. So the age is 66. And then we'll look at the third box, which is the day after you turn full retirement age. So let's start with the red box. So here's an individual who's 64. They currently make $65,000 a year and they want to collect their Social Security benefits. Well, Social Security says you can't only earn $18,240. This is the most you can earn in a year without your benefits being penalized. And the penalty is $2 for every $1 over this amount. So here in this case, if the individual earns $65,000, we do the earnings test, they're over the penalty test of $46,000. Heck, the penalty is $23,000. So the penalty would eat up all of their benefit. So if you're under full retirement age, you can only earn $18,000 a year and collect your benefits without any penalty. So a lot of times it doesn't make sense if you make over $18,000. Now, the year in which you turn full retirement age, so the year in which you turn 66, Social Security allows you to make more money. You can earn $48,000. So if you earn up to $48,000, you can collect your benefits without any penalty. There again, if you make more, penalty is $1 for every 3 that you're over the $48,000. So in this case, the penalty is about $5,000. Does it make sense to take the benefit early? It really depends on the individual in this situation. Maybe it does, maybe it doesn't. But the bottom line with working and collecting your benefits, once you hit 66 in one day, you can earn all you want. You can earn $1 million a year and collect your Social Security without any penalties. Now, that doesn't mean it's not taxed, because it will. It'll be added to your ordinary income, and then it will be taxed. So you can't avoid the taxes on it, but you can avoid the penalty by waiting to 66, your full retirement age. So that leads us into taxes. Will my Social Security be taxable? Well, there again, it depends. It depends on how much other income you have outside of Social Security. So if anybody in retirement just has Social Security, it will not be taxed. That's a good thing. The bad thing is you only have Social Security as your income in retirement. So what Social Security looks at to determine if your Social Security is taxable, they look at what is called your provisional income. And provisional income starts with half of your Social Security and then add in everything else. So if you're working, add that income. If you have a pension, add the income. If you're taking money out of your IRA account, add that to the income. If you have rental property, add that income. Interest, dividends, even tax-free municipal bond income, add it all in. So add in all your income to half your Social Security. If you're married and that's over $44,000, then 85% of your Social Security income is taxed at your rate. It doesn't mean 85% of it is a tax. It's just 85% of your benefit will be taxable. So, and then if you're single, if it's more than $34,000, 85% of it is taxable. If it's between 32 and 44, then half of it is taxable. And there again, if it's under 32, none of it is taxable. So again, it's a good thing, bad thing. You know, you want your income to be more than 44,000 if you're married in retirement, but then the bad thing is 85% of your Social Security is taxable. So the good thing, it's not all taxable. The most it would be 85%. When it started out, none of it was taxable. Social Security was tax-free, but now we need the tax on that income. So let's look at some studies about Social Security and some case studies. But let's look at some of the changes here quickly that happen every year with Social Security. So in 2020, this is our max. This is the max of the most of our income from our paycheck that can be taxed by Social Security at 6.2%. So that's increased from 132,900 to this year 137,700. If you make over that, it's not taxed by Social Security. Here's the full retirement benefit. This is the max benefit that anyone can receive at 66 this year, basically $3,000 a month at 66. No matter what your income was, that's the max benefit. Now this, if you're 66 and you delay it to 70, this 3,000 grows by 8% a year or 32% over 4 years, which basically is another $1,000. So at 70, the max benefit is going to be about $4,000 a year. Not bad. If you have a husband and wife that both are at max salaries, you know, there's you know, $80,000, almost $100,000 just in Social Security benefits. Average workers is about $1,500 a month, and married couples is about $2,500 a month. So in 2015, Social Security made some changes to benefits and certain filing strategies, and it was due to that Social Security disability was underfunded, so we've gotten rid of some filing strategies. One of them is something called the file and suspend. This doesn't exist anymore, so I'm not really going to talk about it, but there's one more filing strategy called the restricted application that does still exist, but is being eliminated. And the way this strategy works is, first of all, you have to be born by January 1st of 1954 or sooner. So basically 1953, that puts you at 67 this year. You have to be 67 this year or older to use this application, this restricted application. And what it enables you to do is if you're if you're married or divorced, you can file against your spouse or ex-spouse for half of their benefit while yours grows. So let me show you exactly how this works. Let's say I'm 67 years old this year. Let's say my wife is 66. She has to file for her benefit. Let's just say hers is $2,000 a month. She turns her own benefit on. I then file a restricted application, and I file for half of her benefits. I file for a spousal benefit, which is half, $1,000 a month. So I collect $1,000 a month until I'm 70, and then I switch to my Social Security benefit, which has been growing by 8% a year for the next 3 years. So this is a great strategy for people who fit this age of, you know, born in basically 1953 or earlier, for married couples and divorced individuals. It's a great strategy to pick up, you know, tens of thousands of dollars in benefits that you may not know that existed. I've shown this to neighbors. I've shown it to family members. So if you fit that, maybe we can talk offline about it, because it's a great way to pick up more income from Social Security Administration. So let's go into some quick case studies on Social Security. We see these every month when we do our workshops. You know, this is just a 60-year-old individual whose benefit at full retirement age would be $2,000 a month. So He's not married, he's not divorced, he's not widowed, he has no strategies where he can, play off of one another. It's just his benefit. If he were to start it ASAP at 62, let's say he's able to retire and collect his benefit, and we have to make an assumption, how long will this person live? Well, we're going to assume that he's going to live to 85 years old. So if he collects at 62, the earliest, and lives to 85, his total pull from Social Security would be about $547,000. Now, with some planning and possibly delaying the start of his benefit, and again, living to 85, we always have to make an assumption how old someone is going to live to determine what strategy is right. If he lives to 85 and delays the strategy to 66, his total benefit jumps up to $626,000, $80,000 more. I don't know about you, but I'd take 626 over 547 all day long. What we try to get people to look at when it comes to Social Security and figuring out what strategy is best for you is not get so hung up on the monthly number. A lot of people look at the monthly number, boy, that'll pay a lot of my bills. That'll pay half of my bills. What you really want to do is run a calculation, run some assumptions, figure out how long you think you might live, and then run the analysis and take the bigger number. Don't think so much about what that monthly number is, more about if I live to X, how much am I going to take from Social Security? And we do this all day long with calculators that we use and software programs to help determine the best strategy for you to get the most over your lifetime from Social Security Administration. And it's the same for divorced individuals. We find divorced individuals all the time from our monthly workshops. In this example is an individual who could use the filing a restricted application. So again, she's 65. Let's just say that she wanted to file right away at 65 years old. She lives to 90. She just takes her own benefit of $1,875 a month. She lives to 90. She takes $653,000 away from Social Security. But if she delays it till she's 66, 1 year, files for half of her spouse's benefit, so let's call that, $800, $900 a month. She collects that for 4 years while this grows, her benefit grows to 70 and then switches. Look what the total take from Social Security is. It's $840,000. I'd take 840 over 650, again, all day long. We use a calculator, we use a software program that shows what strategy is right for you. We don't get hung up so much on the monthly benefit payment. We want to look at, if I live to X, how do I get the most money from Social Security? And then married couples is the same idea. They're 66 and 64. Here's one spouse's benefit, the other spouse's benefit. If they file right away, live to these years, 85 and 90, that's their total take. With some planning, they could do the filing a restricted application possibly. Look what happens to their benefit. It increases by, $170,000. So this is what our planning looks like. We like to focus in on the total pull, not so much the monthly benefit. So that kind of gives you an idea of what the overall, it's kind of a high overview of Social Security, but the bottom line with Social Security, everyone's different. Everybody's plan is different. Think about it. Are you single? Are you married? Are you widowed, divorced? Are you part of a dual income household? Is there a high income earner? Is there a low income earner? Is there a big age difference between spouses? When do you want to retire? How much do you have saved? How much do you need to spend in retirement? These are all the things that you should look at when trying to determine what's the best strategy for you for claiming your Social Security benefits, not just, hey, what's that monthly number? So that's how we look at it. We look at it as a holistic way and try to help you maximize the benefits. And again, it's the foundation of a strong retirement plan. Okay, let's transition now into the different types of retirement accounts that people are using today as they plan and prepare for retirement. We're also going to touch on taxes in retirement and how these plans are taxed. So the biggest, retirement account that everybody's using right now to plan and prepare for retirement is a qualified retirement plan. And that's an account where all the money goes in free tax dollars. All the money grows and compounds without taxes until the day that we start to take that money out. And at that point, it is all taxed as ordinary income. So what I like to say is, you know, Uncle Sam has a partnership in your retirement account. There is a tax lien slapped on that account. And for the younger people, the younger people on this webinar, you know, we have no idea what that tax rate is going to be 10 years from now, 20 years from now, 30 years from now. So that's the big uncertainty. That's one of the biggest risks in retirement is what our future tax is going to be. We're going to talk more about taxes going forward, but think about it. There's a tax lien on there, and we don't know what that tax rate will be going forward. So the money grows and compounds tax-free. It will be taxed on the way out. Common examples of these plans are, of course, 401k plans, 403bs, and of course the thrift savings plan for our federal employees. Also, IRA accounts can be pre-tax, of course, and then of course taxed on the way out. Here's our contribution limits. For those over 50 years old, we can contribute up to $26,000 a year in a 401k, 403b, thrift savings, 457 plan. If you get a company match on top of that, I mean, that could easily be $30,000, $35,000, you know, maybe $40,000 a year. So once you hit over 50 years old, you can really start stuffing a lot of money into these 401k plans. If you're under 50, it's $19,500, still a good limit for contributing to these plans. Now for the individual IRA and the Roth IRA, if you're under 50, it's $6,000 a year. Over 50, it's $7,000. So right now, you know, a married couple could do $7,000 for 2019. They could do $7,000 for 2020. There's $14,000. A married couple could do $28,000 right now for last year and this year. A good way to really force feed maybe a Roth or an IRA. So in December, this past December, just a few months ago, Congress passed an act called the Secure Act that made some changes to some of the rules of these qualified retirement plans. The first rule that they changed was the elimination of what was called a stretch IRA. In a stretch IRA, what that meant is that in the past, prior to this year, if a non-spouse inherited your IRA, the money could stay in that plan over their life expectancy. So let's say, you know, my father passed away a few years ago and I inherited the IRA, and let's say I'm 50 years old, I could leave that money in the IRA over my life expectancy. So let's say it's in the 80s, I could leave it in there for over 30 years. I'd have to take out a small amount every year, you know, 1 or 2%, but the majority of that money could stay in there over my lifetime. They've eliminated that now. That does not exist anymore for non-spouses. If your spouse inherits your IRA, they can leave it in over their life expectancy. But when it gets to a non-spouse, so when it gets to your children, they now have to take that money out over 10 years. It has to be cleared out in 10. So they can take it out over the 10 years, or if they wait till the 10th year, it all has to come out. So let's think about the consequences of this. You know, a lot of people, you know, every generation wants to be better than the previous, right? So you want your kids to be more successful than you are. And if your children are more successful than you, that's great. They're making more money. They're probably paying more in taxes. So when your children, if they're more successful than you, are inheriting these accounts, they're going to be taxed at higher tax rates than you are in retirement. So that's, you know, the Congress made this change because they know they're reducing the time period the money stays in this account, and they know it's going to be taxed at higher rates in the future. Also, let's say your children aren't as successful. You know, God forbid, you know, they lose their job, or they're on the brink of losing their home. They're in financial despair, and they inherit a large IRA, and they have to take it out all at once. There again, it's going to be taxed at a higher rate, maybe higher than your rate. So this, I think, is a very big negative to this change. Now they've squeezed in a positive. They've increased the required minimum distribution age, the age at which we have to start taking money out of these plans. They bumped it out from 70 and a half to 72. Big deal, a year and a half. I don't really think it's necessarily that big of a deal, but they tried to throw a positive in here. This is a big negative. This getting rid of the stretch IRA is a big negative for taxes in the future. They've removed the contribution age for IRA accounts. It used to be 70 years old, whether you're working or not. So let's say now you're 75 years old, you're still working, and you want to contribute to an IRA, you can. If you're 80 years old and still working, you have earned income, you can contribute to an IRA. So they've removed the age limit for contributing to an IRA. For younger employees who are starting new 401ks, they've increased the automatic enrollment from 10% to 15%. That's a good thing. And finally, they've encouraging, believe it or not, annuities in qualified plans. Now, for a lot of people, annuities are a dirty word when it comes to personal finances, but personally, I think there's a place for them in certain situations. You know, think about the word annuity. What is an annuity? Annuity is a guaranteed payment. It's a guaranteed income payment. What is Social Security? It's a guaranteed income payment. What is a pension? It's a guaranteed income payment. So annuities are right in the right situations. It's a way to just ensure part of your retirement money. So by them encouraging it in retirement plans, I think it's a good thing, especially for younger employees. So big part of the planning process when it comes to retirement planning is planning for required minimum distributions. Required minimum distributions are now, they have to start at 72 years old. Whether you want to spend this money or not, it has to start coming out at 72. At 72, I like to just say it's basically 4% of the account value. So we saw the age 70 earlier in the discussion, right, with Social Security. Social Security can be delayed to the age of 70. So if we're delaying Social Security to 70 and we're delaying distributions from our IRAs to the max of 72 years old or 70, are we creating the possibility of a tax time bomb? And the answer there is yes, we are. If we're delaying both, it could be causing major tax problems. So it doesn't always make sense to delay both. You know, maybe it makes sense to take Social Security and delay your distributions from your IRA, or maybe it makes sense to start spending your IRAs early and delay your Social Security payments. So, but if you delay both, it could cause a problem. Think about it. The max Social Security payment right now at 70 is going to be $4,000 a month. Let's call it 50 grand a year. Let's say somebody has $1 million in their IRA. That's going to be 40,000. That's going to be 4%. There's 90,000 just on a real basic individual. If it's a husband and wife, there's 180,000. So maybe it makes sense to spend the IRA earlier at a lower tax rate and delay Social Security. Just food for thought, but RMD planning is a big part of the planning process. My clients know what their RMDs are going to be way before 72 years old. It's smart to know what they are when you're in your 60s. And so that leads to the idea of possibly converting some of this IRA money. Maybe you don't spend it in your 60s, but maybe you convert it from, let's say, a 401k or an IRA to a Roth. Maybe you pay a little bit of tax on it now, dump it into a Roth IRA, and then never pay tax on it again. Again, we're going to talk a little bit more about this in taxes, but this is a strategy for people maybe in their 60s who are retired and delay Social Security, and they're in a lower income bracket, convert some of this money into Roth so that it's never taxed. And now let's jump into taxes. You know, a couple of years ago, we made some changes to the tax laws. We've reduced the tax rates on our tax brackets. So rates have come down, But what did they do? They took away a lot of our deductions. And a lot of people right now are using just a standard deduction. People who file jointly can deduct a standard deduction of almost $25,000. You know, they've taken away, the biggest thing they took away was they limited our state and local deductions to $10,000. Think about a lot of real estate taxes in this area approach $10,000 or more. So by limiting our state and local deductions to $10,000, it's really starting to push a lot of people to a standard deduction. And these are our new tax rates, okay? So if we take a look at a person who's filing single, and let's say they're retired or not retired, it really doesn't matter. But let's just say their income is like $70,000. Their highest tax rate is 22%, and that's down from 25%. So that's good. I mean, these are historically the lowest tax rates we've ever had. And I think when it comes to taxes and retirement, we have to look at where we think these rates are going to be in the future. These tax rates are only good for another 5 years, unless somebody extends them, but they're set to expire in 5 years. So these rates are historically very, very low. And when I do these workshops where I'm face to face with the attendees, you know, I like to always ask everyone, you know, who here in the room thinks that taxes are going to be lower in the future? You know, please raise your hand. And no one ever raises their hand. Everybody always thinks and believes that taxes will be higher in the future. You know, you look at our deficit, you look at our 22 trillion in deficit. Prior to what's going on right now with the virus, we were running a deficit of $1 trillion a year with record tax revenue, with record unemployment. We couldn't have a better economy, and we're still running a deficit. That is scary. So now we're going to add what? 2, 4, 6 trillion more on top of our current deficit to get out of this virus problem? Look, we have to be proactive in what we think and where we think taxes will be in the future. If everyone believes they're going to be higher, we've got to be proactive in taking advantage of these lower rates. Same for married filing jointly. Let's say we have a couple and their income is $120,000, whether they're retired or not. Their upper bracket is 22% compared to 25. Okay, we want to take advantage of these lower rates. So let's look at a retired couple. Let's look at someone who's maybe retired, and let's say their income is $125,000, and they have a lot of money in their IRAs. Does it make sense? Let's say they're at $125,000. Does it make sense to fill this bucket up with another $10, $20, $30, $40,000 from their IRA, pay the 22% rate, and dump it into a Roth where it's never taxed again? Does that make sense? Well, if we all think taxes are going higher in the future, yeah, I think it does make sense. And it's the same for an individual. If an individual, let's say their income is $70,000 at the 22% rate, does it make sense to fill this bucket up with IRA money and get it taxed at 22% and put it in a Roth? You know, I think it does. You have to be proactive. You have to, you know, you can't look back 10 years from now and say to yourself, boy, you know, I was on that webinar with the University of Maryland and the guy was talking about taxes. You know, you have to be proactive. You have to anticipate where taxes are going. You know, I love sports analogies. I love sports. And one of the greatest athletes of all time was Wayne Gretzky. And he always talked about, why were you so great? People ask him, why were you so great? And he was so great because he anticipated where the puck was going, not where the puck is. And I think it's the same with taxes. We have to anticipate that. Also, anyone realize that there is a tax penalty for dying? If you're a married couple and someone dies, there is a widowed tax. And I'll show it to you right here. Let's say we go back to that couple that has $125,000 in income. and one passes away. So let's say their income drops to 100 because they lose a Social Security payment. So they're 125,000 at 22%, the highest rate. Income drops to 100,000 because they lose a Social Security payment. So now they're single. 100,000 is at the 24% rate. So not only do they get a drop in income, they get an increase in their upper rate to 24%. You have to be proactive when it comes to taxes. If someone does your taxes, that's great. If you do them yourself, that's also great. But tax preparation is January 1st through April 15th. This year it's July 15th, right? That's tax preparation. That's looking backwards. Tax planning is April 16th through December 31st. That's forward looking. You need to be forward looking when it comes to tax planning, and it's a big part of what I do for my clients, especially those who are near retirement or who are in retirement. So that ends my taxes. You can see I'm very passionate about it. You've got to be proactive. You have to have a game plan of where you think taxes will be. All right, let's wrap this up in the planning process. There's 3 phases to retirement planning. There's the accumulation phase. That's for people in their 20s and 30s and 40s that are, during their working years, are able to take more risks to generate greater returns so their retirement savings can grow and work for their goals. If you're in your 20s and your 30s and your 40s and this market's dropping like it is, 20, 30, 40%, great. You should be doing the Snoopy dance. You want it to go down. You want it to go down as much as possible because you're buying more each and every month, hopefully, in the contributions to your plans. You want the market to go down while you're working because you can buy more. But when you transition into the distribution phase, and that's when you approach retirement, enter retirement, the focus now becomes, how do you make this money last as long as you do? You can't afford this type of volatility in the distribution phase. And then finally, there's the preservation phase. Now you've set up all your income, you've got all your income coming in guareteed. Now your goal is to, how do you pass this on to your heirs? You've worked hard for it. How do you pass it on and make it possibly help your beneficiaries? So number 1 risk in retirement, living too long and running out of money. Longevity risk, number 1 risk. We're living longer. We're more active. We're living a healthier life. We're eating right. We're exercising. What this chart shows us in kind of the goldish line, the top line, is for married individuals, married couples who make it to age 65 together. Right? If you make it to age 65 together married, there's a 50% chance one of you makes it to 90 years old. Now, I'll use my parents for example. My parents were only married until 65, but they were married for 65 years. My father passed away in his late 80s, but my mom just turned 91. So for them, it worked out, 50%, one of them made it, and now there's a 25% chance my mom makes it to 94. So, longevity is a big risk, longevity risk. The longer we live, the greater the odds are that all these bad things can happen to us, like running out of money. Think about it. If we knew how long we were going to live, the planning process would be so simple. If the big guy upstairs could just text us on our phone and just text, hey, Patrick, I'm texting you now. You're going to live to your 87 and a half years old. Would the planning process be so easy? Couldn't I just bury my money in my backyard and just take out enough every day to live because I knew how long I'm going to live till? So that's the uncertainty. We don't know how long we're going to live. We have to plan for longevity. It's just the big uncertainty. So we're living longer. Number 1 risk, longevity risk. The other big risk in the big shift in retirement responsibility is that we've gone from pension plans to 401k plans, right? In 1991, 85% of corporate America had a pension plan, right? The IBMs, the GEs, the Coca-Colas, the Microsofts, they all had pension plans. But back in the 90s, the CEOs of corporate America went to Wall Street and said, look, we're tired of owning this risk. We are tired of every time the market goes down, like today, 20, 30, 40%, we've got to take money out of our reserves, put it in the pension plan to make it fully funded. So Wall Street, or CEOs went to Wall Street and said, look, come up with a new plan because we don't want this risk anymore. And what they come up with? They came up with the 401k. Now we own the risk, right? It's okay when we're in our 20s, 30s, 40s. We want the market to go down because we're buying more. But once we hit retirement, get near retirement, we can't afford this volatility. We can't afford these losses, especially if we're spending this money in retirement. So the risk has really shifted to us, the individuals. And there's no other chart or no other slide on my presentation that really explains risk. It's my favorite chart, my favorite slide on the presentation. What this shows us is that when the market goes down, how much does it need to go back up to be even? So if we take an investment, let's say it's in the stock market, stocks are down right now, we start with $100,000. And let's say the next 12 months, at the end of the year, it's down 30%. And let's say the following year, it goes up 30%. Are we even? And the answer is no, because if our investment goes from 100,000 to 70,000, drops 30%, and then goes up 30%, 30% of 70,000 is 21,000. We're only at 91,000. The portfolio needs to go up 43% to get even. That's incredible. So if we get back-to-back negative years, a 20 and a 25, or a 15 and a 20, we're starting to dig these holes that'll be very, very difficult to come out of, especially if we're drawing down this money, if we're spending this money. So this leads to really the second biggest risk in retirement, or the third. We've got taxes are a big risk. Longevity is a huge risk. The next risk, which I think is very big, is what I like to call sequence of return risk. When you get off this webinar, you can ask Alexa, hey, Alexa, what is sequence of return risk? She'll tell you all about it. It's real, it's important, and not enough people talk about it. What it tells us is that if we get negative rates of return early in retirement and we're spending this money, we're going to run out of money. Here's a quick example. This is an individual with $1 million. We get positive rates of return early. We're not spending the money. We've got negative rates of return late. Million grows to 4 million, 6%. We now flip the returns, negative rates of return early, positive rates of return late. We just flip the order, 6%, $1 million grows to 4 million, same thing, but we don't get there the same. We're 8 million at 79, or 800,000 at 79. We're 3.4 million at 79 years old. But if we start taking money out, again, positive rates early, negative rates of return late, negative rates of return early, positive rates of return late. If we get negative rates of return early and we're spending money, we run out of money at 80 years old. If we get positive rates of return early, we end up with 2.5 million. You can't afford negative rates of return early in retirement while we're spending it down. Sequence of return risk is a huge risk in retirement. So finally, these are the 6 questions we need to ask ourselves when we're planning. How much income do you need? We need to figure that out. You need to have a budget. You need to know how much income you need to spend in retirement. How much risk can you take? You can't live a CNBC retirement. You can't live in retirement by what the market does, if it's up or if it's down. You have to have all of your living expenses covered. How do we plan for taxes? Well, we talked about that. We have to plan for taxes being higher, and how do we plan for low interest rates? How do we plan for liquidity needs? We've got to have money in reserves. New tires, a hot water heater, new roof on our homes. This has to be money that's in reserves and part of the plan. How do we protect our spouses and loved ones? How do we pass our money on to our heirs? How do we properly plan for our estate? Powers of attorney, wills and trusts, all very part of the planning process. And finally, what's the first step you need to take to get started? Maybe it's just sitting down with an advisor, sitting down with me. I'll sit down with you and give you a second opinion on what's going on with your plan. So that that ends my presentation. I know it was a fire hose of information, but there's a lot of good information if you just took away, one or two good things from it. I hope it'll help you plan and prepare for retirement. There's a lot of uncertainty currently in the markets, but I think in the long run, we're going to be okay. Here's my information. I offer you to call or email me, or, if you'd like to sit down on a one-on-one consultation, no cost or fee when this thing settles, I'd be more than happy to give you a second opinion. With that, Ellie, I'll pass it back to you.
Great. Thanks so much, Patrick. And thank you for taking the time to really walk all of us through that material. Like you said, it definitely was a lot of material. So I encourage folks to reach out to Patrick directly with questions that you have specifically about your situation. We are running up at the end of time, but we did have a question or two that came in while you were talking, Patrick. So if you wouldn't mind just clarifying one or two things for us here. We had someone who just missed a little information on the Roth versus traditional IRA. Which one doesn't get taxed?
The Roth IRA is never taxed on the way out. The Roth IRA, when you make a contribution, is after tax dollars. So it's after tax money, but the principal and the earnings are never taxed. If you're younger or even older, it doesn't matter. If your current company has a 401k Roth option, I would highly recommend that you consider putting at least some of the money in the Roth 401k and then maybe some in the traditional 401k. You can split your contributions.
Great. Okay. Thank you for that clarification. I am getting ready to wrap things up, I think. Is there anything, Patrick, that you wanted to cover before I wrap up?
I don't think so. I know it was a lot of information to throw at everybody, but, as long as you pick something out of there that you want to focus in on, be it, required minimum distributions or taxes or market volatility and risk. And really, I think this current environment that we're in is really just a shot over our bow to really wake us up on volatility. We haven't had this volatility in over 10 or 11 years. And this should be a little bit of an awakening, not for younger people. I think it's a great thing for younger people. But for people who are closer to retirement, this is a wake-up call. And I think it's time to really analyze what we're doing with our money.
Right. Yeah, you bring up a really good point. So like Patrick said, please reach out to him directly if you'd like more information or you want to discuss your own personal situation. I know we had a couple last-minute questions come in. So a recording of this webinar will be sent to your email address that you used to register for this webinar, as well as Patrick's personal information. So thanks again to everyone for joining us. Huge thank you to Patrick. Hope everyone has a wonderful day. Hope you stay healthy and go Terps.
Go Terps. Thanks, Ellie.
Thanks.